All right, let's get back to these markets here. We want to check in with Shana Sissel, CEO of Banríon Capital here. Shana, we're kind of about 60% way through earnings here. What's your takeaway so far?
My takeaway has been that there has been relatively okay earnings.
Yeah.
They're not awful, but they're not as strong as we've been seeing in the AI trade. In particular, we're seeing some softness in the comments and some disappointments. And I think that that's kind of weighed on the markets. But overall, not the worst earnings season, but not as strong as we've seen in recent quarters.
So, Shana, the S&P is near record highs, but valuations look less stretched because I guess earnings estimates have moved higher also. And I liked your description of the earnings. They're just okay. Do you think investors are underestimating maybe strengths of corporate profits?
Underestimating strength of corporate profits? Not necessarily. As you just pointed out, the earnings estimates are increasing, which makes valuations seem more reasonable. So despite the actual levels of the S&P, the valuation of the S&P isn't outrageous. But to your point, my bigger concern is the increase in the estimates, I think, might be a little too optimistic. And so I am cautious right now, and I have been, as you know, for a while. So I just think with some of the changes to the way that the Fed is communicating to the markets and some of the ways that consumers are behaving, the bifurcation between those with the haves and the have-nots in terms of income, I'm a little concerned about the markets being a little stretched.
What did you make here of what appears to be a new sheriff in town with the Federal Reserve and a new policy of limited disclosure, limited forward guidance here? How does that impact the way you think about these markets?
I actually think the changes that are being made by the new chairman are not negative. I don't think his latest press conference was particularly strong. I think he was inclined to answer as little questions as possible, so came across a little flippant. But I do think the changes he's making in terms of the way he's communicating are positive and reflective of how the Fed had traditionally communicated to the markets prior to the financial crisis. So I like him. I am actually pleasantly surprised. I think a lot of us went into him becoming the chair thinking that he would be more of a puppet than he is clearly not. And so I like the changes he's making to communication. I think that he might be taking it a little bit too seriously. He still needs to answer questions that I think are fairly reasonable. And I think in his last press conference, he didn't do that particularly well. But overall, I think the reasoning behind his decision to be less transparent is one that makes sense and should be the case. The market should be information for the Fed, not reactive to the Fed, and just so expecting of the Fed to bail out the markets and to be very predictable and such. We want to know how the Fed would behave in certain scenarios. So I think being able to communicate his feelings in that respect would be helpful. However, that being said, I don't think it's necessary for him to be completely transparent as to, in the next meeting, we'll be looking for XYZ, like Chairman Powell used to. And so I really like him. I think he needs a little bit of a coaching, if you will, and how to answer questions at press conferences in a way that doesn't come across as stonewalling in a way.
What about alternative assets? You write in your note that private credit remains the part of the market you're most cautious on because structural liquidity mismatch hasn't gone away, but we've heard so many big Wall Street shops downplay the risk of private credit. And a lot of our Bloomberg stories actually still get read. The interest is still there very much so when it comes to private credit.
Well, the interest is there. The problem is where the interest lies. The interest lies in these massive mega funds with the desire and need to do mega deals. I think that's the problem. And the structural mismatches in those structural mega deals, I don't think that the interval fund structure is the right structure. I know it's the one that people want because it makes them feel better about the liquidity, but I say all the time, when I'm evaluating any sort of alternative investment, I want the liquidity structure to match the liquidity of the underlying. And at the end of the day, private credit is not the type of credit that should be as liquid as some of these structures are trying to suggest that it can be. I do think that there's a lot of attractive opportunities in private credit in the lower middle market space, which is deal sizes under
Yep.
even $50 million is reasonable. I think anything under 25 million is very attractive. I think that's the engine that helps small businesses succeed in this country. It's the main place that capital markets get tapped by small business. And I think that's the most interesting part because the deal flow is robust and
Right.
you don't have as much competition in that space for these deals because these lower middle market private credit firms tend to be very focused and very niche and get a lot of opportunity.
Right.
We have one that sees probably 50 deals a month and does maybe one or two.
Yep.
And so that's where I think the interest and the most attractive opportunities are.
All right, Shana, thanks so much for your time. As always, Shana Sissel, she's the CEO of Banríon Capital Management.